For high-yield closed-end funds, CEFs, to buy for a yearly 9.5% dividends. All right, let's, I can't remember who just sent me this, but let's take a gander, shall we? This is by Michael Foster through Forbes. I think you have to actually pay to be on Forbes. I don't know that to be true, but I think I read that someplace now that if you want to be a Forbes contributor, you actually have to pay. Is that right? And look, I don't know if that's true, but it'd be enough to research it. I just don't feel like doing it. But I discount. Forbes has actually sold their good name. That's all there is to it. They sold their good name. I don't know why. So you get all these guys who write now for Forbes who they love to be able to put the credentials of Forbes behind them and market themselves. I don't know who Michael Foster is. I just don't care. It's no different than the guys at Wharton. I got an executive degree from Wharton, and it's they went to some freaking weekend class in Philadelphia, and they get to put on their what's it called, CV, that they have a academic degree from Wharton. Oh, I hate that crap. Anyway, here's a happy guy because he's getting 9.5% yield. Got to get that down there, big guy. First thing you do for a longevity is get that down there. And you do that by watching what you eat and getting out in there walking a little bit. All right, so let's take a look here. July 1st, 2020 Dateline. For high-yield closed funds to buy for nearly a yield, 9.5% dividends. All right. Most folks think and I have not read this article, just FYI. Most folks think retiring on $500,000 is a dream, but most folks haven't heard of high-yield closed-end funds. With the yields as high as 22%, these unsung income plays can fast-track your race to financial independence. Oh, are you freaking kidding me, dude? All right, so here's how. Let's say you're looking to clock out and use your portfolio to replace $50,000 in your yearly income. Many financial advisors will tell you the most you can withdraw out of a conservative stock portfolio is 4%. Good night. Simple math tells us this means you'll need $1.25 million. High-yield investments like closed-end funds turbocharge that because we'll need less capital to get $50,000 annual income stream. If we can find an investment giving us a 5% yield, we only need $1 million. So we could reduce the amount we need to save by $250,000. If we can get higher yields, we can cut it down even more. The bigger the yield, the less to save. All right, so are we seeing a problem here? I just want to show you the problem. The bigger the yield, the less to save. What is inherently wrong with that statement? It assumes the yield that you're getting, you're buying it today, the yield that you're getting, and actually the yield is reflective of the payout amount, is the actually reflective of the dividend, assuming that will continue on until you're dead. Don't make that assumption, man. I'm telling you. Just look at GE. What's GE doing right now on their dividend? Let's take a gander, shall we? I bet they're still paying a dividend. I don't know, but I bet they're still paying a dividend because they got preferred shares. Let's take a look. So we're gonna look at GE. Man, I got to put my Trusty's reading glasses on. I hit 50. I'm getting old. An old man bought these at Walmart for $7. Oh, yeah, look at that. That's pretty good. GE right now is trading at 670 and is paying a yield of 0.58%. 0.58%. So that means, I'm not going to be able to do it off the top of my head. So it's trading at 669. It's paying a 0.58% yield. I should be able to figure out what that is from a dividend perspective, but I'm going to embarrass myself if I try, so I won't. But anyway, you can get what that means. So basically, I guess you could say, how do you do that again? If you go 669 is what it's trading at, 6.69 times 0.58%. Is that a 3 cent, almost a 4 cent per share dividend is what it's paying. 4 cents per share. It looks like that's what that means to me. What was G's dividend 3 or 4 years ago? I guarantee it's a hell of a lot more than 4 cents per share. It's 3.8 according to my trusty calculator. All right, so let's keep reading. So retiree who finds a 7% passive income stream needs $500,000 less than a retiree blindly following their financial advisor. But is a safe 7% dividend yield possible? He's saying a dividend stream. That's another thing that ticks me off. This better be with closed-end funds. The answer is a resounding yes. Closed-end funds are designed to invest in familiar assets, real estate investment trusts, for instance, but are professionally managed to buy and sell assets at the best possible time to hand out a high income stream to investors. The best closed-end funds yield 7% or more and have done so for a decade without cutting their payouts. Oh. Woo, Nelly, where have I heard that before? The best closed-end funds yield 7% or more and have done so for over a decade without cutting their payouts. You can see the average closed-end fund yield is 7.4. The average S&P 500 yield is 1.9. And we can do better than 7% with many high-quality closed-end funds paying more than that. We can boost our dividends to over 9% without breaking a sweat. You gotta be freaking kidding me. Take, for instance, Allianz Convertible Income Fund for corporate bonds. The dividend yield is 11.7%. All right, so what we have here, a dividend yield 11.7, long-term annualized return 4.3. Does anything jump out at you here? What does that jump out at you? All right, we'll go back to that. We got the Gabelli Equity Trust, 11.2 with a long-term annualized year yield of 11.4. What is the long-term? 10 years. Guggenheim Taxable Municipal Managed Duration Trust, 6.7, and then we got the UTF, which is the Cohen and Steers Infrastructure Fund. All right. First and foremost, if we have a dividend yield of 11.7 and we only have long-term returns of 4.3, we're eating into our principal. That's all there is to it. These other ones, Gabelli is trading the dividend yield, is basically giving you back your whole return. That's not solid. That's not without breaking a sweat. That's for sure. A convertible, a convertible is just income fund. It's corporate bonds. We got the municipal managed duration fund. Do you really think? Now that's a taxable. So they're buying. What's those? Oh man, I'm drawing a blank. Build America bonds and stuff. Do you really think you're gonna get 6.7 in a dividend yield on municipal bonds on average are yielding a hell lot more than that, less than that, without any risk to your principal, without any risk to payout? I bet there's leverage to the hilt too. We'll see. So just these four funds, we created a high yield CEF closed-end fund that can get us a retirement income of $500,000 and just $527,000 investment. And these aren't even the best ETFs out there. All right, so let's take a gander. This freaking is going to infuriate me. There's one reason why these little-known funds are the income investors' shortcut to a worry-free investment. Oh, my goodness, dude. Are you freaking kidding me? All right, so let's pause this. I want to look at some of these here. I'm just going to do a brief cursory look here. Let's see if they got any comments on here. I guess we don't have. Why don't they got comments on it? 64 views on this guy. How many views? I like how you can see the views. 48,000 views. But see, it's just freaking clickbait stuff. Oh, it's driving me crazy. All right, so let's see what we got here. No comments. Why don't they have comments? How do you? So let's pause real quick. Here's NCZ. All right, let's take a gander, shall we? Let's just look at, we'll go for Max. How long has this guy been around? Since 2003. All right, so you had... All right, you had $15 a share when it first issued at 2003. Now it's at $3.96. All right, so I don't know what to tell you. You've lost, from a principal perspective, 15 to 4. You got $4 a share on this guy now. So what does that mean when it's freaking paying 11.7% a year? That means it's dipping into your principal, just like I said, big time. And look, we could go back and literally look. You can say I had $15 a share. I bought it for $100,000. I had $15 a share divided by 15. That means I have 6,666 shares at that point. All right. I mean, literally, you could say, and then you can go into it and say, what is your account worth now? Well, you can say 6,666 shares times 3.96. That gives me $26,000. You lost 75% of your principal in this fund. Oh, but great, you've recouped that in a dividend yield. Okay. Yeah, good luck with that. Now you got still got 6,666 shares. Doesn't matter. It's only trading at $3.96. So you've essentially traded, and I don't know how much dividend you got when you first bought. I have no idea. But you're traded all that freaking principal for dividend yield. That's no different than an annuity. Freaking nuts, man. Nuts. Let's see. What's the payout here? Next dividend date. Okay, the payout is 45 cents a share. Let's see. Okay, so we got payout 45 cents a share. That's why it's yielding so much, because the price is so low. All right, so let's go back to 45 cents a share. I wonder if can we look. We used to be able to look historical data. Let's see what the dividend payout was before. I bet it's around that. So let's just bear with me just a second. Say that guy was paying 45 cents a share, divided by 15. That was a 3% dividend yield back then. The reason it's paying such a high yield because the price per share is way down. What is this guy doing, man? So let's go to, we'll just even say 5 years. $3.75 in July. Oh, that's 2020. Let's just do dividends only. So we'll go back to high. There we go. Dividends only. And go to apply. And actually, let's just go. I wonder if it'll let me go back to max here. Crack out. Yep. Okay. Just another thing. It's just infuriating. Look at this. It's paying 8 cents a share back in 2015. Now it's paying 3.8. So when you first bought this guy, if we go back to 2003, you're getting 11 cents a share on the dividend. 11 cents a share. All right, so you got, remember, we had $100,000. We bought it. It was trading at 15 bucks a share when it came to open, when it was open. That's when it was first issued. You had 6,666 shares. You were getting 11 cents a share back then, 11 cents a dividend, 11 cents a share, so times 0.11, which meant you were getting, am I doing that right? 6,666 shares times 11 cents, yeah, 0.11, which meant you were getting $100,000. So we got 11. Oh, that's because it's every month. Okay, oh, perfect. All right, so we're getting 700. It pay monthly? Yes, it does. Pays monthly. So you're getting, all right, 11 cents a share times 6,666 shares. You're getting $733 a month in income. And it did that every single month, March, April. Okay, cool. Yeah. All right, so now we times that by 12. That gives us $8,799 is what we were getting back then, which is basically an 8.8% yield. All right, 8.8% yield, because that was the dividend it was paying. It was paying 11 cents a share for 12 times a year. So you're getting $8,800 in income off a $100,000 investment. Okay, so now let's fast forward now. So remember, we have 6,666 shares right now, and now it's paying 3.8 cents, and it looks like it's paying that every year. So 6,666 shares times 3.038. It's paying $253 a month. So 253 times 12 equals 3,000. Dude, you got freaking killed in this thing. You got, your income went from $8,800 down to $3,000 a year. Excuse me. So now your initial investment is yielding 3% because you initially bought it at $100,000, and now it's worth. You were getting $8,800 on that initial $100,000 investment. Now you're getting $3,000 a year on that initial $100,000 investment. Now, if you bought it today, you could be getting that dividend yield. But I mean, so you get $3,000 on a share. So if you would have bought $100,000 today at $3.96, $100,000 divided by 3.96, you'd have 25,000 shares. 25,000 shares. All right, and you're getting $3,000. Wait, what did I just do there? 25,000 shares. So if you would have bought $100,000, you'd have 25,000 shares. That's what I want to say. That's each paying 33 cents, 3.8 cents. 25,000 shares times 0.038. You would have got $950. You would be making $950 a month, $11,000. There's your 11% yield. That's if you buy it today. So it's true, but if you're looking at history, you would say if you look at history, you've lost 75% of your principal, and you've lost two-thirds of your income. You got killed in this investment. Why would you do that again? Don't do that. For the love of me, man. That's kind of where I want to stop here. That's just straight up ugly. That's ugly. This guy's recommend. I just want to see what's the. Let's go to GBAB. We've already done this long. Well, let's go in part 2 of this. I'll look at the other ones here in a sec. All right, thanks.